Hello and welcome. If you have a 401k or a similar retirement account, you've almost certainly come across them. Target date funds, they're often the default choice. With names like Vanguard 2055 Fund or Fidelity 2060 Fund, they promise a simple, all-in-one solution for your retirement savings. Just pick the year you plan to retire, and the fund supposedly handles everything else. It sounds almost too good to be true, doesn't it? A professionally managed portfolio that automatically gets safer as you get older. Is this the ultimate set-it-and-forget-it strategy that every single investor should be using? Or is this convenient, one-size-fits-all approach hiding some major drawbacks? In this video, we're going to break down target date funds from every angle. We'll explain exactly how they work, who they're perfect for, and when you might actually be better off building your own portfolio from scratch. Let's find out if this incredibly popular investment is the right choice for you. So, let's start with the basics. What exactly is a target date fund? Think of it as your portfolio on autopilot. A target date fund, or TDF, is a single mutual fund, or ETF, that gives you a complete, diversified portfolio, all tailored to a specific retirement year. The entire strategy is built around something called a glide path. This is just a predetermined plan that automatically adjusts the fund's mix of stocks and bonds as you get closer to your target retirement date. Here's how that works in practice. When you're young and retirement is decades away, the fund is aggressive. It will hold a high percentage of stocks, maybe around 90%, to maximize growth potential. The rest will be in more stable investments like bonds. Then, as you get closer to retirement, the fund automatically and gradually becomes more conservative. It starts selling off some of those stocks and buying more bonds. The goal here is to protect the wealth you've already built up and reduce the risk of a big market downturn right before you need the money. Finally, once you're in retirement, after passing that target date, the fund reaches its most conservative mix of investments and typically holds it steady. The focus shifts from growth to generating income and protecting your nest egg from volatility. The magic of this is that you, the investor, don't have to do anything. There's no rebalancing to worry about, no agonizing over your stock versus bond split. The fund managers handle it all. It's a complete, packaged solution that contains thousands of individual stocks and bonds from all over the world, giving you instant diversification in a single investment. Now, let's talk about why these funds have become so incredibly popular, especially in workplace retirement plans. There are three powerful benefits that make them a go-to choice for millions. First, and this is probably the most important one, is simplicity and what I call behavioral guardrails. For a complete beginner, the world of investing can be overwhelming. The sheer number of choices can lead to analysis paralysis, where you're so scared of making the wrong choice that you end up doing nothing at all. A target date fund completely eliminates this problem. You make one single decision your retirement year and you're done. You're invested. This simplicity is invaluable because it gets people into the market who might otherwise stay on the sidelines. But it goes deeper than that. The fund also acts as a powerful behavioral guardrail. It prevents you from making emotional and often costly mistakes. We all know the temptation to panic sell during a market crash or to chase the latest hot stock that everyone is talking about. The autopilot nature of a TDF keeps you on a disciplined, long-term course, protecting you from your own worst instincts. The second huge benefit is professional diversification and automatic rebalancing. A high-quality target date fund from a major provider like Vanguard or Fidelity instantly gives you a globally diversified portfolio. You get exposure to US stocks, international stocks, US bonds, and even international bonds, all in what the experts believe are the correct proportions for your age. And as the market fluctuates, with some investments going up and others going down, the fund automatically rebalances itself. It sells a little bit of what has gone up and buys a little of what has gone down, forcing you to buy low and sell high without you ever having to lift a finger. And that leads us to the third benefit, hands-off convenience. This is the ultimate set-and-forget feature. You can set up your automatic contributions from your paycheck and literally not look at your portfolio again for decades, confident that your investments are being managed according to a professional, long-term strategy. For people who have zero interest in managing their money or who are simply too busy, this convenience is absolutely priceless. But of course, despite all those amazing benefits, target date funds are not a perfect solution for everyone. The very features that make them so simple can also be their biggest limitations. Let's look at the hidden drawbacks and when one size fits all might not fit you. The first major drawback is that one-size-fits-all glide path. The fund strategy, its shift from stocks to bonds, is based on an average investor. But what if you aren't average? What if your personal tolerance for risk is much higher or lower than the model assumes? Maybe you have a pension or rental income, which means you can afford to take on more risk in your 401k. Or perhaps the thought of a market drop keeps you up at night, and you'd prefer a more conservative approach even when you're young. A target date fund can't account for any of your personal circumstances. If you're more risk-averse, its aggressive stance early on might be too stressful. And if you're a more aggressive investor, its shift to bonds as you age might feel way too conservative, potentially limiting your long-term growth. Drawback number 2 is cost. While modern target date funds are generally low cost, they are almost always more expensive than building an identical portfolio yourself using individual index funds. That's because the TDF is a fund of funds, meaning it has an extra, small layer of management fees on top of the fees of the underlying funds it holds. For example, a TDF might have an expense ratio of 0.12%, while the individual index funds it owns might have an average cost of just 0.05%. That difference sounds tiny, but over 30 or 40 years of compounding, that small fee difference can add up to tens of thousands of dollars in lost returns. The third drawback is a total lack of customization and control. When you buy a target date fund, you're buying the fund manager's entire philosophy, for better or for worse. You have no say in the specific companies or bonds the fund holds. You can't tilt your portfolio toward investment styles you believe in, like value stocks or high-dividend companies. You can't exclude sectors or countries you might be skeptical about. You are giving up all control in exchange for simplicity. So, after weighing the good and the bad, what's the final verdict? Who are these funds really for? You should definitely choose a target date fund if you are a beginner investor just starting out. They are also perfect if you want the absolute ultimate in simplicity and hands-off management. If you know you are prone to making emotional investing decisions and want a system to keep you disciplined, a TDF is your best friend. And if you're happy with a solid, market-matching return and don't want to bother with the details of portfolio optimization, it's an excellent choice. On the other hand, you should consider building your own portfolio if you're a more knowledgeable investor who actually enjoys managing your own money. If you have a strong opinion about your own risk tolerance or asset allocation that differs from the standard glide path, you'll want more control. Also, if you are extremely cost-sensitive and want to squeeze out every last fraction of a percent by minimizing fees, building your own portfolio is the way to go. And finally, if you want full control and the ability to customize your investments, you'll need to do it yourself. For the vast majority of people, especially those just starting their retirement saving journey, a low-cost target date fund from a reputable provider is an excellent, good enough choice. It prevents the big, catastrophic errors and delivers a professionally managed, diversified portfolio with incredible ease. Let's do a quick final recap. What are they? All-in-one funds that automatically get more conservative as you approach your retirement date. The pros: ultimate simplicity, automatic rebalancing, and behavioral guardrails that protect you from emotional mistakes. The cons: a one-size-fits-all strategy, slightly higher costs, and a complete lack of customization. At the end of the day, the ultimate investment strategy is the one that you will actually stick with, consistently, for decades. For millions of investors, the simplicity and built-in discipline of a target date fund make it exactly that. It might not be perfectly optimized for your unique situation, but it's profoundly effective. Don't let the search for the perfect portfolio stop you from implementing a good one. And for many people, a target date fund is a very, very good one. Thank you so much for watching. If you found this helpful, please hit that like button and subscribe for more content. See you next time.